tell me what to do. I don't give a damn if you say you disapprove. I'm gonna make my move, I'm gonna make it soon. And I'll do it cause it's what I wanna fucking do. Cause all these opinions and all these positions, they come in millions, they blocking your vision. But no, you can't listen, that shit is all fiction cause you hold the power.
Oh, hello there!
You have to excuse my voice, I am a little bit under the weather. Or, as my wife would say, you're probably dying. Yeah, man flu, I know. If you are invested in a fund that follows the S&P 500, about 40% of your money is effectively tied to the performance of just 10 companies, most of which are deeply invested in AI and development of AI. The S&P 500 is an index that is made up of publicly traded stocks of the 500 largest companies in the United States. And each one is giving a weighting based on the market size of that company. This means the larger the market cap, the more it's represented in the S&P 500 index. The S&P 500 is up more than 40% since October 2021, thanks largely to the AI momentum. Nvidia especially has seen massive gains in the past couple of years. It rose more than 230% in 2023 and 170% in 2024. It's now more than 7% of the S&P 500. That means that one company now carries as much sway in the S&P as the bottom 224 companies combined. For many people, and I would say most investors in target date funds, a significant portion of your portfolio is now in the S&P 500. I think investors have gotten so used to the idea that the S&P 500 is a relative low-risk way to invest, and it's been kind of obscured by the fact that it's a technology mega-cap fund today. And these carry an inherent risk. Most investors are not really aware of this. Others feels this bias towards tech and AI is a great opportunity to get ahead. I think tech continues to lead the market higher and higher and ultimately has really changed the game for us investors. So what does this concentration mean for the million of Americans whose financial futures depend on the S&P 500 and people who want AI exposure with a lot less risk? As I said, the S&P 500, it's what's called market cap weighted index. This means the bigger the company, the bigger the influence on how the index moves. Investors measure market capitalization by taking the number of shares a company has, multiplying it by its stock price. Therefore, if investors are driving up a stock's price, this increases the company's market cap, which will then increase the company's weight in the S&P 500. That's one of the reasons why the S&P 500 has become so heavily driven by AI and tech giants. Nearly half of the S&P market cap has a medium to high exposure to AI, according to Citigroup estimates. That means that a lot of these companies in the index have put big bets on emerging technologies and they're set to come out. The question is, will those bets pay off? A lot of people are really optimistic about these companies, which again is driving up the stock price. This is going to continuously increase the market cap, which in turn will increase the market weighting in the S&P 500. But because of the surge in AI enthusiasm, the S&P 500 performance now increasingly tracks a few very large tech stocks. The median stock in the index has risen less than the top performing tech stocks. Over the last few years, the vast majority of earnings and revenue growth that we have seen in the S&P 500 have come from tech and AI. To some investors, that kind of concentration is risky, as again, others see it as strength. I think it's a great thing, because right now the biggest assets are in the US. When you think about across the country, it's Silicon Valley, it's AI, it's the arms race. That's why you're seeing even on S&P the additions continue to be new tech, next gen versus maybe old legacy. And that's a positive as this continues to play out. The old idea of the S&P 500 was to give investors a broad look at a much more diverse set of stocks, just to follow a whole index that way. Whereas before you also had the Dow Jones, which was just 30 names, obviously much more concentrated and a much smaller slice of the markets. So have you seen investors like Warren Buffett of Berkshire Hathaway or John Bogle of Vanguard? They touted the strategy of investing the S&P 500 exclusively. If you set it and forget it, and just buy and hold the index, you will make money over a long period of time and become rich. There have been ETFs and mutual funds that have started around the S&P 500, and the attraction there is that they mirror the index very closely, and they are low-cost funds that are managed passively, so that you're really getting exposure to the big names without paying a lot of money. Investors will often strive for a diverse portfolio to ensure that one stock that has some sort of cataclysmic event that might cause the price to drop by, let's say, 50%, wouldn't have an outsized impact on the value of their portfolio. So, having the diversification of the S&P 500 with allocations across 500 separate names historically would provide this insurance against one name blowing up and having an overly negative impact on your portfolio value. I think set it and forget it is no longer as applicable if your entire portfolio for retirement is in the S&P 500. Even regardless of what's happening in the AI market, it really isn't well diversified. The top 5 companies alone in the S&P 500, Nvidia, Microsoft, Apple, Google, and Amazon, they represent around 30% of the index. And so many people aren't aware of how their retirement portfolio's performance is really dependent on the performance and success of these 5 companies. The S&P 500 is still diverse for sure. You still have 500 names that make up the index. It is, however, much more concentrated than it has been throughout most of its history. There is probably some level of truth in calling the S&P 500 just a mega-cap tech fund at this point. But when you look at the broader economy now, so much of this is tech and tech related. It's becoming something that's all-encompassing, so having an index that is representative of our economy, being so weighted toward tech and AI, you could actually argue makes a lot of sense. But some see this concentration as an upside for investors. You want the average investor to have more exposure to tech rather than less. I'd rather be owning tech in a specific ETF than in all ETFs. If you just think tech is where the growth is, that's where the asset values are going to continue to go higher. And you want to be more exposed to AI, and I think these indexes have really created that opportunity. We are living in the 4th industrial revolution, and I think the markets are starting to reflect that, and it's an exciting time to be an investor in tech. I believe big tech is going to continue to lead this market higher. I think it will spread to mid-cap and small-cap. The point is, this is going to spread to the rest of the market, but it starts and it ends with big tech. As AI continues to spread across different sectors and reshape the economy, investors may need to re-evaluate what it means to diversify their portfolios. For investors in the S&P 500 and the markets more generally, it pays to have a diversified strategy. So if you're investing in the S&P 500 and you're concentrating in that, you run the risk of having losses that might interfere with your personal timelines, say retirement or other investment goals. And you also may feel the urge to react emotionally if the market is down or even if the market is up. So experts always say, have a diversified strategy. There may be times when the S&P 500 does better, and then there may be times when international stocks, value stocks, small cap do better. Yes, but if you have a diversified strategy with other stocks and bonds, you will have a portfolio that may not rise as dramatically, but again, it won't fall as dramatically with the market's ups and downs. It's all about your strategy and timeline. Financial experts recommend spreading risk across different company sizes, sectors, and regions of the world. That mix typically depends on the investor's time horizon, and someone's time horizon to retirement could be 10, 15, 30, or other. And it's quite significant because that allows the investor who has a longer time horizon to take on more risk, because they have much more time to recover if things don't go as they would like. So typically, if you're an individual who has around 30 plus years to retirement, we're going to focus primarily in stocks. We may have a more high allocation towards tech because it typically has a higher long-term performance versus a person who has 10 to 15 years to retirement. He would still have stocks, but maybe do something a little bit more defensive. And by defensive I mean not all in on tech and growth, but maybe having an allocation to more value-based companies, more traditional stocks, maybe dividend stocks like Johnson & Johnson, consumer staples, or utilities. These provide dividend income that offer more stability, but still gives you some long-term growth. This strategy starts with knowing what you already own. It's important for investors to understand, of the ETFs and mutual funds they have, what is my current exposure to AI? And if I buy stocks out of that, am I comfortable increasing my exposure in that significant of a way? I think people just see sometimes funds or ETFs as like a blend of the portfolio, not realizing that they could be building more concentration and less diversification on how they purchase individual stocks. Another way to lower concentration risk is to change how much you invest in the S&P 500 itself. The easiest way is to maintain exposure to the S&P, but lessen the overall exposure to tech and AI. You could go with an S&P 500 equal weighted index exchange traded fund. The difference there being, instead of each member being weighted by their market cap, each one is weighted the exact same. So you don't get these outsized influences from a handful of large names or one sector that is leading the returns. Being in the equal weight index certainly has its drawbacks. When you have a bull market like we're experiencing, the largest names are leading, you will miss upside here. However, it does give you some level of reduced exposure in the event that the largest names are the ones that crack and go down. So maybe my own so-called best portfolio ever is now a bit too much like an almost pure tech portfolio. But in my opinion, it's the best way to invest in AI. It's almost never the first AI company which will win in the end, and having a tech index is my way of getting great gains with less risk. My perfect portfolio consists of 60% in VGT, that's Vanguard's tech ETF, which is a pure tech. I have 20% in SOXX, this is iShares Semiconductor ETF, also bit tech. I have 10% in VHT, which is Vanguard's healthcare ETF, and then I have 10% in SMIN. This is iShares India small cap ETF. I believe India is going to be the new China. Just let us see what happens in 10 years. This gives me a tech/AI exposure of almost 80%. That is actually fairly high risk portfolio, and maybe it should be more like the original portfolio I made back then, where there were also some more value-oriented ETFs. But again, I have a long time before retirement, so I will take on that risk. If you don't have as much time left, to retirement, then your portfolio could be 20% VGT, 15% VNQ, that's Vanguard's real estate index, 15% in VCR, that's Vanguard Consumer Discretionary Index, 15% in VDC, that's Vanguard Consumer Staples, and 15% in VB, Vanguard Small Cap Index Fund. This will give you a fairly diversified portfolio, still only stocks, not so much diversified as using bonds too, but it would have given you the stability and some good returns. Of course, that portfolio would have given us a lower return than the standard S&P 500 in the last 10 years. But is it worth it? Are you the person that panics when the markets go down? I don't know. It's all up to your risk level and your strategy. Is it worth getting these lower returns? Maybe. Again, depends on your strategy. I am at least not at that stage of my life yet. So when I say it's easy to get AI exposure, that was a bit simple. But as we know from the internet boom, it's not the ones who come first who wins. As back then, the winners haven't even been revealed yet. So instead of going after single stocks and companies you think might win, the answer is more likely to be ETFs like VGT or SOXX. I have tried single stocks and I made a killing, but I have also seen my portfolio being cut in half real fast. I don't really like that drama so much. Just a 10% drop really hurts my portfolio. I'd rather not have 50% growth one year and see the portfolio lose 50% next year. So I'm more comfortable with my around 20% compound annual growth over a longer period. You might say I have gotten older and wiser. Others might say I have gotten more scared. I don't care either way. I have what I need, and everything from now on is just extra icing on top. This is also why I'm slowly shifting into dividend portfolios, so I have a steady income no matter what. So how about you? Are you going all in on AI and single companies? Or are you just using the standard ETFs available? Either way, just a simple choice of investing consistently no matter what has you ahead of the 80% of the herd. You need to know what you do and don't panic. That is my mantra. And as I always say, the best investment you can do is in you. The more you learn, the more you earn. Bye.
I have a dream, that's all I need. I'll make it happen with some work and belief. Know what I want, so I'll take it on. I'll make mistakes, but mistakes make you strong. Let's break it down for a minute. I want the crown, I'm gon' get it. You hear me loud, man, I'm winning. Yeah, Charlie Sheen will be grinning. These ladies know that I'm sinning, and this is just the beginning. I'm closing in the ninth inning. There ain't no point in resisting.